Good afternoon. Welcome to our latest webinar to review the economy and market update. Today, we're pleased to be joined by an old friend and colleague, John Silvia, who is with Dynamic Economic Strategy. I've known John now for, over 2 decades, going back to his role as chief economist at Scudder Kemper Investments. And John, since then, you've gone on to work with the Senate Banking Committee, and we'll talk a little bit about that later, as well as be chief economist for Wells Fargo for close to a couple of decades. So we're very pleased to have you with us today, and we look forward to this discussion.
Thank you.
So let's kick it right off if you're ready.
Yes, sir.
It's been quite a while since the focus has been on inflation. It seemed to have been dead for a long time. So we want to make sure to cover this subject in some detail. You can talk about the current situation in a couple of different ways: too much money chasing too few goods, or a supply-demand imbalance. But no matter how you talk about it, we really need to break down the underlying components to understand the issue. I suppose as an economist, you're more comfortable with using supply-demand charts. And let's start with the demand side. In your view, what are some of the key factors that have led to a surge in demand? And are there signs that some of these factors are abating?
Yeah, thank you very much, John, for the opportunity to speak. And you're indeed correct. You always need a framework in economics when you're talking about what's happening, what's likely to happen, and what are the pressure points. When you start out with demand, we always like to think about what are our leading economic indicators. We want to see where this economy is going, and we want to cover several different sectors of the economy to make a good judgment about what's happening or what's going forward. We always start, of course, with the American consumer. And here, consumer sentiment has been positive, continues to be positive, and suggests that there is good economic momentum going forward. A second economic indicator we always look at is jobless claims, because that tells us something about what's happening with the employment numbers going forward. And those numbers continue to decline. So it's good to see that fewer and fewer people are actually applying for unemployment. And as you know, John, and probably many of the people in the audience know, several states now are discontinuing the federal supplement. So it'll be interesting to watch that number going forward. As far as business investment goes, what we'd like to see is capital goods orders. This is ex-defense, ex-aircraft. What's happening with those numbers? Now, those are slowing down, suggesting that we've got good momentum in the economy right now, but there is some slowdown ahead over the next 6 months to a year. And then finally, building permits. They accompany the numbers on housing starts. Those also have started to slow down. In part, you can imagine, John, simply because home prices are up double digits in so many parts of America today. So when we look at those leading economic indicators, and they're all published, so we can follow them going forward anytime we want. But we do see the momentum now being fairly strong, but there is some slowdown going forward.
Okay. Well, I appreciate that. So that wraps up, or is a summary of what's going on the demand side. Let's focus on the supply side. And we've heard a lot about these supply chain bottlenecks that have to do with the economy reopening, and certainly been a cause of some current inflation. How do you see this long term? And again, are there signs that some of these issues are abating?
Yes, what this breaks down, John, into what you and I have talked about before. There are basically 3 parts to this story that are rather interesting. One is the reopening. So we're familiar with the reopening with respect to rental cars, hotels, airplane, air travel. All of those have a lot of price pressures because now you have a lot of people with income who want to travel, want to go out, and all of a sudden there isn't a supply there to meet it. So there's immediate price pressures in those areas. Supply is a little bit short. Second, there are the bottlenecks. Being in the Midwest, you're probably pretty familiar with the challenges in terms of chips for automobiles. So again, that bottleneck prevents the production of automobiles to the extent that people would have expected going forward. We know that energy, we saw the shutdown in the pipeline. That certainly has an impact in terms of gasoline prices. And then finally, hiring workers, getting workers back to the job continues to be a bottleneck simply because, as you know, there's a tendency to be hesitant. Do I really want to go back to the office? Am I concerned about COVID? Is everybody else going to have a vaccination at the office? A lot of issues there. But there is this underlying broad-based inflation that is occurring when you look at apparel or furniture and a couple of other categories. So it's not all bottlenecks. It's not all reopening. Some of it is the underlying price pressure of some certain categories.
Well, I've spent a lot of hours talking about going back to the office policy, and I suspect others on this call have as well. But so you are definitely seeing signs, or maybe not, that these issues slowly but surely in their own different ways, in their own different arenas are being worked out, or is this looking like much an extended long-term problem and long-term factor for inflation?
No, John, I think for most offices, most jobs, most workers, it is being worked out. We are seeing a couple of interesting things. Jobs openings are pretty strong. There is a high level of people quitting their job because, again, they anticipate getting something better later on. So that's working out. Again, openings are showing up. Companies are willing to hire. Workers are willing to move. There is the barrier, as you know, with federal benefits on top of state benefits. Those federal benefits, along with the state benefits and healthcare subsidies and childcare subsidies, mean that in some places, the total benefits exceed the median household income in some states. So that's a true barrier to getting some of the workers back. What we're going to look at, John, in terms of an indicator, is labor force participation rates going forward and the unemployment rates for college and high school students. Those unemployment rates should start to decline and labor force participation should start to pick up. And that'll be really good to see.
Okay. So you, in terms of the labor force, and you mentioned the enhanced governmental employment payments, whether it's this month or in a couple of months, depending on the state, you think you're looking for a pretty robust employment picture in the latter half of the year?
Yeah, definitely, John. I think what we'll see is easily 300,000 plus job gains. And that's pretty solid for the US economy. What we're also likely to see is some pressures in terms of college graduates' wages. Those wages probably will pick up a little bit because there's a lot of demand for those skills going forward.
Okay. Of course, just as you're watching the economy closely, so is the Federal Reserve Board. And they've pretty much gone all in on describing this current bout of inflation as temporary, or in their speak, transitory. In your view, how much of this Fed speak is really an attempt to dampen inflation expectations across the economy so that inflation doesn't really work its way into expectations, versus just a pure, call it academic analysis forecast based upon the true numbers?
I think that's a good point from my perspective, John, is that they are trying to dampen inflation expectations. But when I look at the Fed's actual numbers, I do see that inflation is picking up. And that's very important for investors, portfolio managers, and strategists. In 2019, the core PCE deflator for the Fed ran at 1.7%. Now, the Fed is telling me Then in 2022, they expect 2%. In 2023, they expect 2.1%. So inflation is rising. It's not all transitory. And so the challenge, I think, for a lot of investors is, okay, now I have to deal with some rising inflation. Yes, going back to your point, the Fed's trying to dampen inflation expectations. But when we look at the University of Michigan survey, their 1-year and 5-year inflation expectations numbers have actually risen. So there is an increase in inflation expectations despite the Fed's point of view.
Mm-hmm. Is it more than a little ironic that that the Fed's long-term prediction is spot on with exactly where they've stated they wanted it to be?
Absolutely. So again, there's a little bit of caution there in terms of, are they being just hopefully positioning themselves that we're going to get it right? Well, the market sometimes can just take off on its own.
Yeah. And so it seems as if what the Fed is really trying to protect against is inflation expectations working their way into the way companies and businesses price and employee contracts work, and just an expected inflation environment like we've had it in the past. Here and there, I guess I should say. Is there anything we can learn from history in terms of how we go from a low inflationary environment with low expectations into an environment where there are expectations and that gets kind of built into the numbers?
Yeah, that was a good question that you had raised to me earlier, John. What we have in the past are two noted periods. One, of course, the Jimmy Carter era, the late 1970s, but also in the period 2010 to 2011, which is fairly recent. So this is not old history. In both cases, inflation expectations rose. And in both cases, the 10-year Treasury rate rose. And in both cases, the US dollar depreciated against the British pound. And I use the British pound simply because the data is available. A lot of other currencies, like the euro, was not available in the late 1970s. So yeah, there is that pattern. When inflation expectations pick up, 10-year yields tend to rise and the dollar tends to depreciate. So it's built in. They build in those inflation expectations.
Okay. And so you think, well, let's talk about the Fed a little more. And they really seem to be telegraphing that they're going to be moving ever so slowly. I think at the last press conference, Chairman Powell said something like, "This is the meeting to talk about whether we're going to talk about doing anything," or something to that effect. Maybe I got one too many talkabouts in there, but they really seem to be have learned their lesson from I'll call it loose rhetoric of the taper tantrum. So they want to be slow to move forward and reduce their purchases of treasuries and mortgages, let alone increase the Fed funds rate. Do you see a risk that the Fed is being too complacent with its policies and may get behind on inflation? And when do you see tapering and rate increases in your forecast?
Yes, John, I do see that the Fed has been too complacent. I think we only have to go back to last week and see how the market was surprised that so many Fed officials ramped up their interest rate expectations for 2022 and 2023. And again, going back to some of the rhetoric you just mentioned, there was not too long ago that Chairman Powell and other members of the Fed said, it's too early to talk about, too early to talk about, too early to talk about. And all of a sudden, last week, they're talking about it. So I think the Fed had been too complacent. The inflation numbers caught them off guard. There is also a commentary, John, by Chairman Powell that inflation seems to be sticking more than they had expected. So there's a little bit, in terms of going on here. My personal expectations is I think they will start to reduce or taper their bond position probably in the first half of next year, and probably the Fed will raise the federal funds rate the second half of next year. And again, as you and I have talked before, John, what's important is there's a lot of rhetoric when you read about it and you're trying to be dispassionate about it, that the Fed is not in a position where there's a lot of support for continuing to buy mortgage-backed securities. A lot of people have commented the housing market's pretty strong. Why are you supporting the market like that? And then second of all, why are you interfering with market prices? So perhaps when the Fed starts talking or actually starts tapering, it may be mortgage-backed securities that take a bigger hit as a percentage of the Fed's holdings. And that's something we need to be very, very careful about.
You know, when the Fed is scheduled to speak, and you know they're on CNBC, and it almost seems like the world comes to a stop, and there's such a focus on the actual words and comparing the words to last month and last year. It just seems misguided. I don't know. What are your thoughts about that? An economy, a market where we're hanging on the words of a Fed chairman like that?
Well, I think it can be misguided because you're getting the rhetoric from the Fed, but it has to match up with the data. And I think what you saw over the last 6 months, the Fed was continuing to say, perhaps as a little bit as you hinted earlier, that, okay, we're going to get our inflation goal. Don't worry, it's all transitory. It's going to go away. And here we are last week. Well, maybe not all transitory. Maybe it's more sticky. Inflation is a little bit stickier than we expected. So I think the challenge for most portfolio managers is look at the data, see what the data is telling you, try to see, does that really match up with the Fed's rhetoric? And if it doesn't match, how are we going to adjust our portfolio? And I think what you've seen over the last week or so, there is definitely an adjustment in portfolios in response to the inflation shift that you hear from the Fed.
I think you'd probably agree that the Fed has access to better data than anybody else. And yet they're often criticized, and this is not a new phenomenon. This goes way back into the Ben Bernanke days and well before that, that they have trouble forecasting. You think that's a fair observation?
Absolutely, it's fair. When you look at the Fed's projections, they put out a table, and I'm sure most of your portfolio managers and business strategists know this. They put out a table and say, here's what we expect the numbers to be in terms of inflation, economic growth, and the unemployment rate. Well, if you go back in time and look at the evolution of those numbers, you can see that the Fed, like most forecasters, get it wrong, and sometimes get it wrong very, very much. So again, it's all a grain of salt. So you get the Fed rhetoric, and I'm a portfolio man. Let's say I'm a portfolio manager. I see what the Fed's saying. I see what their table is looking at. I consult with my consultants, whoever they are, and say, okay, how does this match? And you come to the conclusion, well, sometimes it does, sometimes it doesn't. But the Fed does make a lot of errors in forecasting. There's no doubt about it.
It's a tough business, predicting the
Indeed.
future. I'm sure we're all humbled from time to time by that. So let's move on to interest rates and the future direction of interest rates. How do you see them here in the U.S. And globally, and how does the value of the dollar weigh into that forecast?
So for me, I see interest rates moving upwards. There are four fundamentals here. Obviously, the first one is the Fed will probably raise the federal funds rate as the base rate going forward. Second, I do see some additional inflation pressures going forward. So inflation will probably pick up a little bit. Again, even if it's only from the Fed's current position of 2.1% going to 2.2 or whatever. I do see a weaker dollar in terms of the negative incentive for foreign investors to put their money here. Again, avoiding capital losses on the currency. And then finally, if the Fed does, in fact, taper in terms of its treasury purchases, that's less demand for treasuries in the face of what appears to be continuing significant supply in terms of the federal deficit. So for me, interest rates probably going up over time. The second part of your question has to do with the dollar. And from my point of view, what we're seeing is the Fed is staying fairly easy for a while, but the Bank of England, Bank of Canada look like they're tightening policy a little bit. They're buying less securities. So there's a change there. Economic growth has picked up in the EU and in China. So I would say that the dollar probably will depreciate another 3 to 5% over the next year.
Yeah. Well, it's a tough environment for savers, and certainly our insurance company clients would be savers. By the way, they're the economics of their cash flow work, and to earn an interest rate that's really well below current inflation and below longer term inflation, even if the Fed's forecast of coming right into 2.1 or 2.2%, whatever it is they've targeted. That's still a tough environment when you're basically negative in terms of real returns. It's tough for savers these days, and really it is a penalty on those who have saved. Would you concur with that?
Absolutely. I think if you look at the data for the last 3 to 5 years, even though, quote, inflation is very low, the rate of inflation is still higher than your rate of return on cash as well as short-term treasuries. So effectively, it's a negative rate of return. And oh, by the way, you still have to pay taxes on that interest. So there's a big negative incentive. So it's not surprising that a lot of people have moved further out in terms of maturity on their portfolio. They've sought other assets. And as you know, John, one of the challenges in our business is TINA. The argument for equities is oftentimes there is no alternative. I'm not getting much on bonds. I'm certainly not getting anything on cash. So what am I going to buy? I'm going to buy equities. So there's a little bit of a challenge there in terms of the overall allocation in the portfolio.
And certainly that's what early on in the pandemic, that's what the Fed was trying to do, is force cash into risk assets to keep them from cratering. But as we've recovered and spreads have narrowed and there's not the return there, that becomes a much greater challenge for the Fed. And is that back to why they're so cautious in their rhetoric and inching along?
Yeah, it's one of the great stories, John, that it's a lot easier to get into something than out of it. And I think the Fed's in a position now where changes in interest rates would have a negative impact on at least some equity positions and some financial asset types. So the Fed has to be very careful in terms of how aggressive it acts. Now, you and I have talked about before, 1994, 1995. Well, maybe some people weren't around then, but we were around and realized that when the Fed acted and surprised people with the extent of their moves in the federal funds rate, both the bonds and equity markets sold off. So that's something to keep in the back of our mind. It's not so much the Fed moving, but if the Fed moves more than what's discounted in the marketplace, then there could be some significant changes in asset values.
Mm-hmm. Yeah, that's a very good point. Thanks. We're in a weird period where rates are extremely low and growth is projected to come in annually in 2021 around 7%, whether you look at the Fed's own forecast or the blue chip economic consensus, which I believe you're a contributing member to the as a blue chip economist. So, but 7% is what they're looking for this year, and with continued growth heading into 2022 and beyond. Do you think, with respect to GDP, there's a greater risk of an upside breakout versus the 7%, or downside? And looking beyond this year, where we're halfway in and it seems like the numbers are fairly baked in the cake, looking out to the foreseeable future, do you see any risk of a weaker economy or even perhaps a recession?
I think it's important, John, to always understand the economy operates in cycles. So it's not always boom bust, but it's this up and down cycle. And I think what we're seeing, at least this year and next year, is certainly the upside of the growth cycle. You've still got a lot of fiscal stimulus. You still have the Fed easing. You still have a lot of pent-up demand. And the leading economic indicators that we talked about earlier still signal good economic growth. But the challenge, of course, is going to be 2023 and 2024. When the economy does slow down, you're going to have the end of some of the fiscal stimulus. You will have the Fed raising rates at least a little bit. They may be tapering in terms of buying less debt, sovereign debt, and so interest rates will tick up a little bit. And inflation's rising, and so it's going to cut into consumer incomes. So while we're seeing the upside in 21, 22, we'll probably see a little bit of a downside in 23, 24. I don't see a recession. The indicators don't show it. But I think it's important when you're investing and you're looking out 3 to 5 years, something you and I talked about before, the Biden administration and their budget numbers have 2% or less growth out 3 to 5 years. So when you're thinking about investing today and trying to get your returns in 5 years, realize that towards the end of that, economic growth will be rather slow compared to today.
I'm impressed you view the administration's economic forecast as good, solid economic analysis. So I'll rethink that.
Well, administrations tend to be optimistic. So if that's the optimistic case, we need to be careful.
Good point. So you started to talk about investments and your ideas on current valuations and future returns. What are your thoughts about that? As you see the economy and look out to the capital markets, what asset classes make sense to you and are you thinking about?
Yeah, still at this point, in terms of an economic projection, economic growth is still pretty good for the next year or two. Inflation's rising a little bit. Dollar's probably going to weaken. Interest rates are going to still rise a little bit. To me, I still favor the equity market and high-grade corporate debt. But I think the squeeze is gradually going to show up with higher interest rates, slower growth, and I think the more marginal speculative markets are going to have to get a repricing. And I think that'll be quite challenging. Another thing is the emerging markets. I know the emerging markets have been attractive, but when you're talking about slower U.S. growth, you're talking about less imports from emerging markets. And when you're talking about higher U.S. interest rates, you're talking about increasing the cost of finance for emerging markets. So I think those are pretty challenging going forward. And I know it's always fashionable and it's fun to talk about certain things, but there was a recent article on SPACs in the Financial Times saying, okay, maybe SPACs to reality, you may come up short. So I think at this point in time, it's always important to understand at the margin, as things change with slower growth and higher interest rates, what happens to some of these investments that have been such favorable investments over the last 2 or 3 years that may in fact have a lot of problems sustaining growth going forward?
Well, a lot of your words might be viewed as an investor as cautionary here and there, but I think for our insurance clients, it was almost music to their ears because whether they're our clients are a life insurer or a health insurer or property casualty insurer, they're by regulatory statute, the bulk of their assets are in high-grade fixed income, and the ongoing challenge really is reinvestment and degrading book yields over time. And if anything was on their wish list, it would be a gradually rising, but rising interest rate outlook so that they could, once again, start to earn a little bit of money on net new cash investments as opposed to, be stuck in this very, very low rate environment. It's a challenging environment for insurance companies of all stripes, and probably more so for life insurers where for the most part, life insurers have to pay on their liabilities. And in many cases, they have minimum rate guarantees that they've offered to their policyholders that were crafted in, in an interest rate environment that is not, that is really nothing like we're seeing today. So our clients would really love to see a rising rate environment. There's the other side of this, and it doesn't get much discussion at all these days, but I think it's in the back of our mind. In particular, I'm sure it's in the back of your mind, given your history with the Senate Banking Committee and working with Phil Graham, who those of whom are on the call and remember Phil, and he still is active in publishing opinion pieces in the Wall Street Journal. But that was back in the days when the Senate Finance and Banking Committee actually did something, and he was, and with you as the chief economist, was a key driver of the legislation to really lead to a balanced budget. And the budget deficit and debt really, nobody seems to care much about it these days, but sooner or later, it's going to have to be addressed. How big of a problem do you see this being? Do you think it has any impact on the dollar as a reserve currency, as well as the capital markets going forward?
Yes, the basic bottom line, as you know from an economist, is there is no free lunch. Context matters. People will talk, well, the deficits don't seem to be having any impact. Yeah, but think about this. We've had low interest rates, low inflation, and excess savings in the US economy. So when the federal government goes out to sell its debt, a lot of it is being bought by the Fed. And so there isn't a lot of floating market out there relative to what you would have expected otherwise. So it doesn't seem to have a lot of interest rate impact. But we've known from history, when you look at places like Italy or Greece or Argentina, Europe, even the UK back in the 60s and 70s, when you have continuing rising debt, but you have higher interest rates and weaker economic growth, then the problems start to show up. And so I think when you're looking at a 3 to 5 year horizon, that's when you can really expect those rates will start rising on the federal deficit. A couple of things are again important. Remember, from the Biden administration, and we talked about that, you have economic growth slowing to about 2% over the next 3 to 5 years. Now I've got more deficits, Congressional Budget Office estimates, and I've got slower economic growth to finance those deficits. So to me, that's a problem. And historically, there have been some nations that have printed a little bit too much money, and you end up with much higher inflation as a way of a means of paying off that debt. So I think for investors, yeah, it looks great now, but I think when you're looking at a 3 to 5 year horizon as an investor, it will be probably much more difficult. You will have higher interest rates, higher inflation, probably a weakening dollar. Once again, John, you see this all the time. When a government in a situation has a lot more debt to finance, inflation's rising, and oh, by the way, what happens to their currency? It weakens over time. So again, that's probably where our dollar is going down over time.
That's interesting, but it's hard to pinpoint what over time means, though, right? When a problem is not a problem until it is a problem. But when it's hard to say when that happens. I mean, it's almost expectations have to change, but it seems like historically they don't change gradually. A fraction a day. It seems like they're non-existent, and then and then there's a crisis. Is that your read of history?
That's very fair, John, because if you look back, in the 1960s and 70s, one will say, well, yes, it was obvious inflation was rising. But if you look back at the data and you look at the policies at the time, inflation did not rise systematically every year at the same rate. it was up and down. There were periods where inflation slowed down. And so, yes, it's very difficult to get the overall flow of information, but you can get a sense of the trend. And to me, the trend is inflation's rising, interest rates are rising, and we have a real problem with the federal deficit over time. My time schedule is, as I mentioned earlier, 21, 22, you're gonna have good economic growth. In 23 or 24, when you see the rising deficits and all of a sudden economic growth is slowing down, that's when people are gonna really start asking, what am I doing with my portfolio? It'll be quite a challenge, I think, in 2023. And again, you and I will be here to talk about it.
Well, as rates rise, it's one thing today to print debt at very little interest rates, but those have to be rolled over and
Yes,
and at much higher rates. And as that could really have a huge impact on our future budget and of course our kids and grandkids. So no reason to fear that in the near term, but longer term, that's something you're really focused on. Is that the way to describe it?
Absolutely. The Congressional Budget Office has released a number of studies talking about, again, you think about, people talk about interest rates getting back to normal. You know, a 10-year treasury getting back to 4 to 5% means that the interest cost on our debt is greater than any other category in the budget. So that, yes, it is significant changes over time. Congressional Budget Office has released a number of studies on this. So it is an issue.
Well, something to be watched closely. Well, we certainly appreciate your views. It's great to catch up with you. We hope that our clients and prospects have found this to be of value. And again, we want to thank you for your insights. It's great to catch up, John.
Thank you, John.
Okay, bye.